at least the surveillance. Read B2 carefully. Read the difference between B1 and B2. So that's why when you read the test legislation, be very careful. B1 says that in responsibility for payment of the interest or royalty. B2 here, in the case of interest, you see royalty there? No, it's not even in B2. So do you have to consider B2 or not when it comes to royalty? That means B1 is enough already. B1 is enough already. You know what I mean? Okay, and C apparently also we have a match here now. C, before that, check first, interest or royalty back. Okay, so royalty one will be an expense in the accounts of Elephant, isn't it? So can Elephant claim a deduction for that? Elephant use the intellectual property to generate sales revenue in Malaysia. Got income, isn't it? Yes. Okay, deduction will be allowed. So that means, right, 15B1 and C also fulfill here. Match here. So in that case, what happened? Royalty 1 will be deemed as income in Malaysia. Okay, why? Because Elephant, number 1, is a tax resident paying. Number 2, Elephant also can claim a deduction for the royalty expense in Malaysia, and therefore the royalty is income in nature in the accounts of Rabbit and subject to tax because it's derived from Malaysia. Under B1 and also C as well, between C as well. Understand or not? Questions. Do you think Rabbit will be so responsible and so nice to come to Malaysia and pay tax? You get what I mean? It's taxable. You get the royalty income, right? Rabbit, okay, too bad. You have to pay tax. Do you think they will be so honest and come to Malaysia and pay tax? So how to collect the tax? How to collect the tax then? The tax must come from the taxpayer, isn't it? Okay? How to collect the tax then? If they cannot force Rabbit to pay, they force Elephant to pay. It is called withholding tax. That's exactly what I'm trying to deliver. Withholding tax. That's exactly what happened. You know what is withholding tax now? Okay, withholding tax is very simple. That means when Elephant, now, in withholding tax, let's say, now, how much withholding tax, okay, will be deducted from the payment of the royalty? That depends on the double taxation agreement, which I will cover later on. So in this case, let's say just assume that according to the double taxation avoidance agreement between Malaysia and Australia, says that royalty will be subjected to 10% of tax. Means when Elephant pay royalty 1 to Rabbit, right? Elephant will pay only 90% to Rabbit. Another 10%, Elephant will help Rabbit to pay tax in Malaysia. Rabbit will pay 10% and help. Sorry, Elephant will take 10% and help Rabbit to pay tax in Malaysia. So 90% will come to Rabbit and 10% will go to the tax office directly. That is what we call withholding tax. For a simple reason why? Because Rabbit is not a tax resident in Malaysia. The assumption is he will not come and pay tax here. Okay, that is what we call withholding tax. Now, let's look at royalty 2 now. What happens to royalty 2? Royalty 2, will it be subject to tax or not? In Malaysia, back to section 15. 15A is out, 15B1 is there, because the one paying is a resident. Okay, B2, we don't care, we don't look into B2. And then C. Can Elephant claim a deduction in Malaysia not for a royalty payment? Very unlikely, isn't it? Because for royalty 2, it was used in Uganda, and also the sales will happen in Uganda. If the income is not coming back to Malaysia at all, right? I don't think so. Elephant will have a chance to claim the deduction. And if that is the case, right? So 15C is out, but B1 is already enough, okay, for the tax office to tax royalty 2. So which means that this is what we call a double jeopardy. Why double jeopardy? On one hand, like it or not, Rabbit will have to pay tax for royalty 2. Correct or not? On the other hand, Elephant cannot get any deduction. So this is what we call double jeopardy. For royalty one is still okay because tax in the accounts of rabbit, no problem. Rabbit is paying, right? And at the same time, elephant is claiming the deductions. Okay, not too bad. But for the second royalty there, royalty two there, right? No. Pay tax, rabbit have to pay tax, okay? But elephant, no deduction. This is what we call a double jeopardy. You understand now? Okay, this is not good, right? You think this is good? To have, okay, the plant there in Uganda and then elephant paying royalty two. Tax office don't care whether the IP is actually used in Malaysia or in Uganda or not. As long as the royalty is paid by a resident elephant, that's it, subject to tax already. So do you think this is actually a good arrangement? But royalty cannot, elephant cannot claim deduction because the income is not here. So, why do you want to remit back to Malaysia? If you're not going to tax here, why not just keep that in Uganda until you find you need the money, you come back? Some of your seniors say that, oh, never mind, we create the income over here, bring back the income from Uganda back to Malaysia. The income claim deduction off. If you don't bring back, right, you don't have to pay tax. You just bring it back just because you want to claim deduction. You create income, okay, to pay tax here just because you want to claim deduction. Can you can do that, but you can have better arrangement. Yes, royalty two in the accounts of rabbit tax, income tax. Yes, income tax. But elephant cannot claim deduction. So, okay, this is the first lesson in tax planning. Anyone can offer me a good idea to mitigate this amount. You want to learn tax planning, right? For the subject, right? Okay. 101 tax planning. The senior of which part? We are all not very happy with this, right? Okay. Yes, obviously, you're not happy with this, right? So assuming that you are the tax consultant now, okay, and I'm the FC of Elephant and say, what the hell, now you pay tax, this one, the IPO is actually used in Uganda, I won't bring the income back, I can't claim any deduction anyway, but I still have to pay tax. Even though the tax is actually belongs to rabbit, but I still have to do all the withholding tax and things like that, right? Double jeopardy will, then how? Especially if rabbit and also elephant, if they are related one. If these two companies are related, they will be even more upset, isn't it? Okay, on one hand, somebody must pay tax, on the other hand, I don't get to claim the deduction. So if you are the tax consultant, what would be your advice? Tax planning 101, as I said. First lesson. Anyone? 然后我就看到一个女生，我就以为她是美女，然后我那时候差点就小姐姐。Try to read this diagram and try to understand what I'm trying to do. 很帅啊！这太美了，长头发的。Exactly. This is already okay enough. It's a good tax planning measure. Good tax planning advice that you probably can charge elephant about 50,000. Maybe 30,000. Okay, simple idea. Royalty two should not be paid by elephant. Okay, some of the seniors say, why not just get the plant to pay to rabbit directly from Uganda? But the plant is unincorporated. The plant and rabbit, okay, so the plant and elephant, they are still considered as one entity, legal entity. So in that case, right, the payment is still coming from the tax resident of Malaysia. Okay, so if you were to argue that the plant should be one paying royalty two directly to rabbit, right? The problem here is that elephant and the plant being unincorporated, they are considered as one legal entity. So the connection here is not being chopped off. The most important thing is you do not want elephant to pay royalty two because elephant is a tax resident in Malaysia. If they pay royalty two means, right, okay, this royalty will be considered as income in Malaysia in terms of rabbit tax income. So how to avoid this? For royalty one, no issue lah. For royalty two, right, okay, we want to avoid this. One way to do that is set up a subsidiary. When there's a subsidiary and also elephant here, elephant only subsidiary, do we have one legal entity or two legal entities here? Two legal entities. Two legal entities here. So we got subsidiary manage the plant, and subsidiary will be the one paying royalty to the branded directly. So with this, right, we save a lot of trouble. So bear in mind that now by right in this particular diagram here, royalty to paid by elephant. I'm not even sure whether in Uganda, the government of Uganda will allow royalty to be claimed as a deduction in Uganda or not. Okay, because don't forget that we have another one more tax jurisdiction here involved, Uganda. I'm not even sure whether royalty too can be deducted in Uganda or not if the payment is coming from elephant directly to rabbit. This becomes a risk, a business risk that we have to bear. So in that case, by having this arrangement here, straightforward, clear off everything. Everybody happy. Questions? Yeah, first lesson tax planning. Sometimes very small little idea really can solve a lot of problems.
你可以自己 create 一个 account 啊，不要有用过的那种。我想要进去玩，不要。
unincorporated in Uganda, we still pay tax. You still pay tax. And worst thing is now, most of the countries are tax jurisdictions, right? They offer tax incentives only to companies. So assuming if let's say Uganda has got a lot of investment incentives to attract people to go there and invest, right? If the plant is unincorporated, they may not be able to get the tax incentive as well. So if it is a subsidiary, then it's different story. Okay, some of the countries will say that, oh, in that case, right, they will